Drop a like and do share. Leave your comments and do not forget to subscribe for more videos.
What's up guys? This is Manoj Putani. I welcome you all on behalf of the Edipedia world. Fasten up your seatbelts, we are about to take off with the first topic of the day, and that will be enumerate the steps in a financial due diligence review. This question was asked in CA final examination for a few of the attempts, and this question is pretty much common with each and every kind of revisionary test papers when they come before the examination. So enumerate the steps in the financial due diligence review. Number one comes into history. So you need to look into the history of the company and the background of their promoters, because this is something which is extremely important and the first and the foremost priority for any of the organization. You need to understand the history of the business or the background that the promoters are having in that company. Number two, you need to study the organizational patterns, strategies of the operations, targets set from time to time, products being manufactured and traded, product life cycle, adequacy of resources. All these things needs to be studied properly. That involves each and every kind of organizational patterns. Next would be see whether any kind of regulatory authority has imposed some kind of certain restrictions. If yes, then what is the extent of that? That is something extremely important. Next will be business products. So inquire about each and every kind of business products which are available in the market, be it suppliers, operations, profit margin, profit share, market share, competitors, exports, each and every stuff that you can do. You need to inquire the business products. That is something extremely important. Next will be verify the asset and the liability positions, be it patents, licenses, deferred expenditure, R&D, tax liability, legislation, anything be it. You just need to verify the asset and liability positions. Next will be verify the accounting policies and practices and analyze the impact of any of the recent change in the accounting policies. Also, you need to inquire in detail about any kind of material changes that have already happened in the accounting policies and what's the impact of them on the latest statements of accounts. You need to take care of that stuff. Analyze the effect of these changes in the accounting policies and compare it with the acquiring entities policies. Report clearly if in case you find any of the differences in that particular case. Next will be you need to verify the financial statements, whether the same are being prepared in accordance with the relevant statutes, regulations and formats or not. When there is any kind of deviation, you need to report the same. And then you need to analyze the operating results. You need to analyze the operating results in a great detail. You need to evaluate the profit being reported in the latest accounts. You need to inquire into the extraordinary kind of expenditures which are being done, making a trend analysis of the profits of the recent past. You need to compare the profits which are being shown out in the companies by the companies operating in the same industry or market. All these things, be anything about this particular stuff. So you need to analyze the operating results and you need to analyze the components of balance sheet, net worth, look into some of the hidden liabilities, if any, that creates conscious suspicion, and what is the pay kind of particular attention with respect to any of the valuation of intangible assets. So that is something which needs to be done. These all are the steps while you move or proceed towards the financial due diligence review. You need to understand the history, in what way organization patterns are being made. You need to check out the regulatory authorities in that stuff, the business products, the asset and the liability positions, the policies and practices changes, operating results. All these things will be covered under the steps of financial due diligence review. I hope I was able to make you clear with each and every kind of example over here. Shall we proceed further, guys? Let's go. Perfect. So the next question is mention some of the examples of hidden liabilities and overvalued assets. This question has been asked multiple times in this C final examination, be it November 2005, November 2010, May 2012. Let's understand with some of the examples, beginning with hidden liabilities. So what could be treated as hidden liability? Let's suppose you have received some of the show cause notices from income tax department, sales tax department, service tax department. However, you have just not disclosed the same in your financial statements by any of the contingent liability or something else. No, you simply merely concealed that fact of having the show cause notices. So the concealment of the show cause notices that have not matured into demands as contingent liabilities, that's the hidden liability. Again, now that comes non-disclosure for any of the letters of comfort which you have given to the banks and the financial institutions. You have not disclosed the same. Again, that will be hidden liability. Then comes non-disclosure of the sale of some of the subsidiaries and public undertakings, business undertakings. There might be a case that you have, like, let's suppose 5 subsidiaries. Out of the same, you sold out 2 of them. Okay, but you didn't disclose that fact that you have already sold 2 of your subsidiaries. And this is again something which will be falling in the category of hidden liabilities. There might be a possibility that later on you'll have to pay on that. Next will be the product and other liability claims, be it warranty liabilities, product returns, discounts, product liabilities, or liquidated damages, litigations. All these things, if in case you are not showing it up, these are the hidden liabilities. Then comes any of the direct or indirect tax liability. That is also will be classified under hidden liability if in case you don't reflect the same. Then comes pending assessments of sales tax, service tax, excise. Though it's not being shown currently in your eyes, but certainly you'll have to pay for each one of them. So this is something which will be treated as hidden liability in your case. Next will be pending assessments of the sales tax, service tax, excise, custom duty, buyback agreements, and the future lease liabilities. This will also be covered under hidden liabilities. You need to buy back and you have already committed the agreement in that particular stuff. Next will be the environmental problems, any kind of third party claims. Any of such things will be covered under hidden liabilities. Unfunded gratuity, superannuation benefits, unresolved labor litigations and negotiations, all these things will be covered under hidden liabilities. Are you guys clear with each and every kind of example that I provided to you? Perfect. Now let's move towards the overvalued assets. So what all criteria will be covered under overvalued assets? Overvalued assets basically simply mean such kind of assets which have been like valued on some certain price which is beyond the fair value in that particular case. So these are the assets which are overvalued. Okay. Number 1, uncollected or uncollectible receivables. There might be a possibility that you will not be able to get money from Ram. However, you are still showing Ram in your books of accounts as debtors, as your receivables. So uncollected and uncollectible receivables will be classified under overvalued assets. Valuation is actually 0. However, you are still keeping the same in your books of accounts. Next would be obsolete and slow moving inventories. Inventories which are valued above net realizable value. So overvalued assets, any kind of obsolete or slow moving inventories or inventories valued under and above basically NRV will be covered under overvalued assets. Any kind of underused or obsolete plant, machinery, spares, impairment of any of the asset values or due to fall in the market price, market value. This will again be considered under overvalued assets. Next will be assets which are carried at a higher rate than the market value. The capitalization of the revenue expenditure, the foreign exchange fluctuation, all these things will be some things which are being covered under overvalued assets. Then comes the kind of assets and properties which is still under litigation. Litigation is definitely going to create a mess for any of the enterprise. So if the company is showing the assets in overvalued form, definitely in case of assets and property under litigation, all these things will be covered under overvalued assets itself. Next comes investments which are carried at cost, where the realizable value is very less and you know that. So what you are doing, you are simply making and showing and confirming your assets at an overvalued rate, and those who are basically having a very low rate of return in that case. Perfect guys, with this I'll say thank you on behalf of the Edupedia world. Keep interacting via questions, queries in YouTube comment boxes. I would love to answer each one of your queries and grievances. Till then, sayonara, God bless you all, love you, bye.